And while we're waiting for those results, we are joined by Thomas Hayes, founder, chairman, member of Great Hill Capital. Good to see you again. This was a surprise, I think, to both Democrats in how they did better than expected, and to Republicans who thought they would have this huge, I guess, Republican wave. It's turned into more of like a Republican splash. But to the rest of us who have followed politics, I mean, I'm certainly not surprised, and I don't think a lot of my colleagues are surprised that Americans chose to vote for a bit more practicality and a bit less of the crazy stuff on both sides.
Yeah, Phil, well, I think either way, and thanks for having me, this is a good thing for the stock market, which is what I usually come on to talk about. We're in that midterm period where you usually have a slump in the second year, and boy, we've had a slump this year with the S&P down some 20% and the NASDAQ down 30%. But on average, with midterm elections, the following 12 months, the S&P is up 18%. So while things look pretty dim right now, we should look forward as to what might be happening. And what we think will happen, if you look, like you said, the red wave may be a red puddle, but they'll still control, looks like the House of Representatives with a lot less seats than expected, only 225, maybe somewhere in that neighborhood. The Senate, we won't know for some time. The runoff in Georgia is going to be critical, as well as the Senate seat in Nevada with Laxalt. But the result is likely gridlock, and the market loves gridlock because that means no new taxing bills, no new spending bills, and business can get on with doing business. It's also very important from a Federal Reserve standpoint, Phil, because they've been trying to put out two fires. So first and foremost is the supply-driven inflation. They've had to jack up rates to try to destroy demand, which they've been successful at doing. But at the same time, there was some excessive and profligate spending in the meantime. You had the Build Back Better bill with $1.7 trillion while they're trying to curb inflation. And then you had the Inflation Reduction Act of another $750 billion while the Fed was trying to destroy demand. Very tough to destroy demand with that amount of spending. So I think moving forward, the market will say spending's going to be less. This will be a good thing for inflation. That means that the Fed might be able to slow down in coming meetings, which would be very good for markets and generally for the economy.
Here's what's perplexing. In a University of Michigan survey that came out, I believe, yesterday, it surveyed potential voters as to their personal finances. And both parties and independents talked about the importance of personal finance and, of course, the economy. So we know that's issue number one and issue number two in most places. Yet they also say that Republicans would be the best at handling that, but they did not vote for them to handle that. So it leads me to believe that maybe personal finances are better than expected, and the economy isn't as sad as some people want us to think it is. Is that possible?
Well, it is possible. I mean, you look at earnings for Q3, they came in at plus 2.2% versus 2.7% estimates. But if you backed out energy, you're at negative 0.6%. That's the bad news. The good news, we're trading at a reasonable valuation at 16 times forward earnings compared to 18.5 times, which is the average for the last 10 years. And we're still projecting 5.9% earnings growth for 2023, even though earnings estimates have come down about 6 or 7%.
Is that inflation adjusted already, though?
That's nominal. So that's including inflation. So revenues will be higher because you have inflation. But, I think on balance, and you see it too, Phil, you go out to decent restaurants, it's tough to get a reservation still. So there is still some underlying strength in the economy. I think the key is going to be all the Fed policy works on a lag basis. We're starting to see the effect of the demand destruction, like your previous speaker spoke to with the layoffs in Meta, 11,000 layoffs, Twitter, 3,700, Stripe, 1,000. So we're going to see more pain in the real economy. The question is, how much is the stock market already discounted?
Here's the real reason we have you on the show, Thomas. I don't know if you know this or not. I don't know if the bookers told you or not, but we need you to help us make some money. So with rates now at 5%, investors, regular folks, should we put our money in CDs? Should we buy real estate? Should we buy REITs? Where are we supposed to do? Where are people supposed to invest their money right now?
I think what you want to look for is the highest quality companies, blue chip companies that are dramatically on sale that you can start to ease into slowly over time, over the next few months. He who picks bottom gets stinky fingers. So you don't want to put all in all at once. But you look at a business today, Disney. Okay, it's down. It caused about 100 points in the Dow Jones today to be down. The stock was down 13%. This is Disney. Their parks business was up 36% year on year. They added 12.1 million subscribers for a total of 164 million for Disney Plus. The problem is they spent too much on the streaming. Bob Chapek says he's going to lower the cost. They have a price increase going into effect December 8th. They also have ad-backed Disney Plus going into effect December 8th. So I think that's going to work out. But if you look out 3 years from now, Disney down some 65% off its recent highs. That business is going to be bigger all around the world. You got to keep in mind China's just kind of starting to reopen. They've got parks over there. They're going to have more expansion around the world. So I think you want to own some high quality assets like a Disney. Maybe you don't buy it immediately. You wait a few days for it to settle out. But that's going to be a high quality business looking 3 to 5 years out.
Thomas Hayes, I have to thank you. And no, nobody wants sticky fingers. Good to see you, my friend. Thanks again.